Welcome back to Accounting Matters, everyone. I'm Nicole Harger, a Senior Managing Director at Embark, and today we're diving into a topic that's heating up the headlines, boardrooms and balance sheets alike, tariffs. With global trade policies in flux and new tariff actions popping up faster than ever, business leaders are being forced to think a few steps ahead, risk falling behind. Whether it's retaliatory measures from major trading partners, expanded tariffs on steel and aluminum, or proposed across the board increases of up to 25% on goods from China, Mexico, and Canada, the current landscape is anything but stable. It's a reminder that economic policy, supply chains, and accounting are more connected than ever. And while this might sound like a geopolitical issue, the ripple effects reach deep into your operations, cash flow strategies, tax planning, and of course, financial reporting. The need for cross-functional collaboration, from finance and legal to compliance and operations, is critical. So, how do you prepare your company for what's next when the rules keep changing? Here to help us unpack it all is my co-host and resident subject matter expert, Adam Olsen, Embark's head of quality. Adam, tariffs have always been a part of the international trade, but things seem to have escalated lately. What's your take on what's happening right now?
No, you're exactly right. Tariffs, like you said, have always been a part of international trade. But I think what's different now is really just kind of the pace, the scale, and really how they're being used. It's hard to wake up each day with not some type of new headline about what's the latest and greatest around the conversation of tariffs. I will say we're recording this on April 14th, and we don't normally timestamp things, but just given the volatility of the current environment, by the time this potentially is released, or you may listen to this, things could even look different, right? So just wanted to put that out there. But around tariffs, we've really seen a shift in the past decade. They're not just tools that are used for economic protection anymore, and they've really become strategic leverage in everything from foreign policy negotiations to intellectual property disputes. This has put a lot of companies, though, on defense. So one day, like as you mentioned, you're operating under a certain cost structure, and the next day you got 25% taxed on you to your materials, and really no kind of warning or indication or heads up that that's coming your way. So all that being said, the current environment and unpredictability is forcing a lot of businesses to rethink their supply chains, rethink pricing strategies, and even kind of where or even how they're manufacturing a lot of their goods. And that's even before we start then getting into the accounting and reporting side, which is kind of our bread and butter and what we'll spend a lot of time talking about today. And the accounting impacts are layered as well, right? Tariffs can affect your inventory valuations. They impact cost of goods sold, obviously, margins, projections. It can lead to impairment considerations in some cases, and there's even tax assumptions that you got to sort through as well. Bottom line, I would say, is that, it's not just like a trade or operational conversation anymore. There's an accounting and reporting conversation that needs to be had, and that's really kind of like what we'll get into more today.
Yeah, and so it's not just about adjusting what's already in place, right? It's about preparing for what might happen next.
Yep.
Whether it's new tariffs, reciprocal measures, or even shifts in global demand if trade routes do get disrupted. So today we're going to talk through the practical implications, what controllers, CFOs, and their teams should be thinking about, and how to approach supply chain adjustments from a reporting lens, and then some key reminders around accounting treatment and disclosures.
Yep.
All right, so grab your coffee or something stronger and let's jump right in. So before we get into the accounting specifics, let's take a moment to kind of ground ourselves in the basics, because understanding what tariffs are and why governments use them is key to grasping kind of the broader business and financial reporting implications. So let's start simple. What is a tariff?
I know it seems like a simple question, but I do think some people don't understand how tariffs work. And I know they've done some polling around that, and there's definitely misinformation and confusion out there. But at its core, a tariff is essentially just a tax on imported goods. It's imposed by the importer's country's government when those products cross its border. There are a few kind of primary types of tariffs that you'll see used commonly. So ad valorem tariffs are probably the most common, and that's where basically a percentage of the value of the good is taxed or tariffed. So you could have 10% on a certain type of product, or you've mentioned the 25% tariff on steel and aluminum. Those are examples of ad valorem tariffs. Specific tariffs also exist, and that's where there's just flat amounts that are tariffed. And it's usually done on the kind of a per unit basis. So it could be an additional dollar tariff on a kilogram of steel, for example. And then kind of one of the third types of tariffs, there's obviously more than these three, but kind of the three most common. The third type is kind of tariff rate quotas, and that's where a lower rate applies up to a certain quantity, and then a much higher tariff kicks in once a certain threshold is exceeded. So they may allow a certain volume of a type of good to be imported, and then once you kind of get past a certain threshold, certain tariffs start to kick in. So depending on, the goods or the policies that are in place, like companies, they could face one of these types of tariffs or multiples of these types of tariffs, and then, the mix of the goods that they're importing as well, they could see tariffs across the board. So it's a lot to get your hands on.
Okay, so kind of what usually follows after that.
Sure.
We covered the what. So why are these tariffs imposed in the first place?
I guess there's a lot of debate around some of this, but governments historically use tariffs to pursue a few different objectives. Some are economic, some could be political. It kind of depends how you look at things. So one of the first kind of common reasons is what they call is protectionism. And this is because tariffs make imported goods more expensive, right? And this inevitably gives kind of domestic producers a more competitive advantage or edge against kind of those kind of foreign suppliers. And so you'll typically see kind of the protectionism argument used on tariffs in specific types of sectors where we want to more or less protect the domestic industry. And so you see this a lot of times in agriculture, you see it in kind of steel, for example, and even in the energy space. The second kind of reason you see tariffs used is really to help address trade imbalances or push back on where we feel like maybe there are unfair trade practices happening across the globe. And so probably the most common one that we're hearing about today in terms of this is kind of the U.S. tariffs on China. A lot of those tariffs were justified because there's concerns about kind of the forced tech transfer and kind of stepping into IP violations with China kind of taking over certain things. And so we're feeling like there's an imbalance there that we're trying to combat. We're also seeing those kind of trade imbalances being talked about when there were kind of the retaliatory tariffs that were originally put out have now been deferred across a number of nations around the world as well. And then the third one is, and this one's becoming, I think, a little bit more common, is to use tariffs as a way to negotiate in kind of geopolitical discussions. So, tariffs are a way to kind of influence certain policies or threaten certain policies or kind of force the hand on certain things. And so the economic impacts, it's not just a trade issue per se. It's more of a broader foreign policy issue that we're seeing governments kind of use the tariff as kind of a way to, I wouldn't say weaponize necessarily, but way to kind of influence that.
Mm-hmm. So there's kind of a mix of economic protectionism, political strategy, and then revenue generation kind of all wrapped into one policy tool.
Yep.
But it's obviously not without consequences. So
Sure.
Adam, can you walk us through the impact tariffs can have on the domestic economy, so the one imposing them?
Yeah. So the impact kind of like U.S. imposed tariffs has on our own economy is really, I think of it as like kind of a double-edged sword, right? So tariffs, yes, can help domestic producers to be more competitive, like we said, right? Because it inevitably makes kind of foreign goods more expensive to bring into the country. The flip side there is that many U.S. manufacturers rely on those imported goods just given the way the global supply chain works in kind of a modern manufacturing society. So when tariffs kind of hit those imported goods, then the production costs here go up for those businesses that need those components or goods. Those costs then generally trickle down to the consumers because someone's got to pay for that increased cost. So whether you're looking at buying a new car, for example, I think there's a lot of concern around that, which is some of the aluminum and steel kind of tariffs that have been have been raised, clothing, other things like that. Those costs do get pushed down to the consumers. And so we see that, obviously through increased prices. And then which consumers tend to feel it more. When you talk to economists about this, it generally impacts lower income consumers more just because of that inflationary pressure impacts their kind of discretionary income the most. But then there's also kind of the retaliation risk. So you talked about the retaliatory tariffs. And so we've seen some of this in the news as well. It's when like we decide to place a tariff on one type of trade partner, hoping that maybe that'll lead to some negotiations. Well, sometimes they stand their ground, right? And their way of, I guess, going against that tariff is to respond in their own way by raising tariffs against our goods that they're importing. So this can lead to sort of trade war type situations. It can also create slowdowns in production. And so, like I said, this is something we're seeing play out right now between the U.S. and China. So there's definitely benefits for what tariffs can do, but I think a lot of economists will argue that there's more downside to tariffs and they don't usually yield the successful results that we're hoping for.
Right. So I think you kind of alluded to this a little bit. It's not just the country imposing the tariffs that feels the pain. There's obviously serious impacts on the exporting country, so the one kind of facing the new trade barriers.
Yeah.
Right. So now let's kind of move on. We've laid the groundwork on what tariffs are and why they're used. Let's kind of pivot to the real world impacts, because it's not just theory anymore. Companies across nearly every sector are feeling this firsthand. So which industries are getting hit the hardest right now?
Yeah, we're definitely seeing a lot of pressure points across a lot of industries, right? Frankly, you could probably argue almost every industry is impacted in some way, but definitely some more than others. The auto industry, I think, is one of the most significantly impacted ones. Particularly those that are reliant on imports from Canada or Mexico. We talked about kind of the steel and aluminum imports there. So tariffs on their parts and the assembled vehicles, those will inevitably push up production costs dramatically for them. Technology companies, I think, are also kind of under the gun here, especially those that are sourcing a lot of their components, so semiconductors and the like, from countries like China. So kind of going back to my earlier point around the significant tariffs that are being levied against goods originating from China, that industry is going to definitely feel the impacts the most. And this could be increases, of billions of dollars for like a lot of those components that are necessary to be supplied to companies that need them from China. And that doesn't even factor in some of like the supply chain delays that could result as well, and just the production of goods for technology companies. Construction is another one that's feeling it a bit, right? We've talked about steel and aluminum again, so that obviously can create some increased costs. It can also create some project delays and bottlenecks. Retailers is another one. I think you hear a lot of retailers are a bit concerned. So apparel companies, consumer good companies, they're seeing a lot of pressure on their margins that could come from the imposed tariffs. And I think they struggle a bit with whether or not, or how much, I guess, rather, cost they can push down to their consumers, especially in light of the current environment, very inflation sensitive environment right now. How much are consumers willing to kind of own some of that cost? And how much will those retailers have to just impact their margins? And then life sciences companies, I think, is another one that maybe some people don't think about, but they're seeing increased costs as well on a lot of lab equipment and different scientific components that are necessary. And the impacts of those costs can have a lot of downstream implications. It could delay even some of these companies being able to conduct some of the clinical trials that they need to get their products approved, or it could just increase the overall R&D overhead, which probably has accounting implications there as well. So like I said, there's a number of industries that are going to be impacted by these tariffs, and it's just, I think, each one kind of thinking through different strategies right now.
Okay, so would you say, kind of these middle market companies especially vulnerable right now?
Yeah, I think middle market companies and even small family, and those are definitely struggling a bit more. But since we primarily serve a lot of middle market companies as a firm, and we obviously serve larger companies as well, but a large portfolio of our clients is made up in the middle market, and I think they feel a lot more of this pressure. I think it's because they have fewer levers that they're able to kind of pull as a way to strategize or mitigate some of this stuff, right? They don't generally have the same pricing power as a Fortune 100 multinational company that has the kind of the power to like amend contracts and negotiate prices with suppliers. Middle market companies don't tend to have that lever or as strong of a lever there based on their purchasing power. They typically maybe have less optionality when it comes to sourcing. So we've already talked about the need to potentially refine where and how goods may be manufactured. Middle market companies may not have the relationships to really be able to pivot so easily to different sourcing suppliers. And then capital reserves, like just the ability to kind of weigh this or kind of wait this out or kind of ride this wave and see like how they can find stability over time. They may just not even be, they could be so thinly capitalized or have very thin margins that it could be really challenging for them as well. I think a lot of middle market companies, like I said, they do rely on single suppliers. They don't have preferential trade agreements necessarily. And a lot of times I think people also are just locked into a lot of long-term contracts. And so the ability to try to renegotiate, I mean, could be a challenge, especially when suppliers are like, well, like, why do we want to necessarily, kind of give a little there to you all. So I think it's, like I said, I think it's just challenging for those companies to be able to pivot to something as quickly. And so they're really looking at rising input costs and a lot of competitive price pressure with their customers as well.
Okay, so what are some companies doing to help mitigate these risks?
I know there's a lot of, I think people are getting really creative and really trying to just look at all different options out there, right? You got the biggest like obvious answers about like, oh, you need to just bring things onshore to, domestically and produce stuff here and all that. Like all of that stuff sounds great, but that takes time. That takes a lot of money. That's not something that you can just easily do, especially given the global supply chain and kind of the way the global economic markets work. So some other things we're seeing and hearing about companies looking at is one is called tariff engineering. So this is where companies kind of either redesign or reclassify certain products that would qualify as a different kind of duty code. And depending on the duty code and the way those tariffs are applied, it may have like a lower rate. So just a little more preferential. Some are leveraging these kind of duty tariff drawback programs to recover tariffs on exported goods. There are some free trade zone kind of agreements that are in place. So kind of looking at those to try to reduce any obligations you may have. The other ones that I think a lot of companies are doing is just a lot of scenario modeling and really just like, because everything is such in flux right now, right? Like just one day there's a tariff on this, then that's pulled back. Next day there's threats of that. So there's just a lot of like what ifs, I think, out there. And so the scenario modeling, I think, allows companies to just kind of see their cost exposure and kind of simulate what that might look like under a bunch of different scenarios, just so they can be more agile in their planning. And then I think what a lot of companies are really starting to do is just looking at their suppliers and seeing like where there is any wiggle room for negotiation, and trying to see if there's, ways to potentially renegotiate pricing or look at alternative suppliers in the longer run where they can maybe find suppliers that'll be more favorable or allow some more flexibility in the agreements they have just to help with the pricing situations. But like I said, companies are just having to be really agile here. I think there's a lot of forecasting and, all hands on deck, I think, for some of these companies to really think through like what's the best strategy or what options do we have.
Now that we've talked through the different industries that are feeling the pressure and kind of some of the strategic steps companies are taking, let's shift gears and get into the meat of kind of what we do, the accounting and reporting implications of all of this. So, Adam, let's start with revenue. So, under ASC 606, how are tariffs influencing revenue recognition for companies?
Yeah, so tariffs are triggering, I think, number of considerations that kind of fall under the revenue recognition umbrella, especially for companies that are using kind of the input method as a ways to measure progress. That's, not to get too technical here, under 606, so kind of this like cost to cost model that you see used. So in this scenario, if the costs of your imported goods are suddenly rise due to tariffs, right? All of a sudden you've got inventory costs going way up or component costs, whatever. That's obviously going to increase the total estimated contract costs. So under this method, when you're kind of looking at your kind of like percentage of completion or, progress towards completion, this increased cost can drastically kind of change the timing of the revenue. So it could increase it or delay it, just kind of depending on the circumstances. There's also situations where the cost could rise so high that under the kind of the existing contract, you could be in a situation where that contract is no longer profitable.
Mm-hmm.
And so this is then kind of forcing you to look at potentially like an immediate loss recognition under kind of that onerous contract guidance, not explicitly in 606, but there's, prior guidance around onerous contracts that are applicable to a number of industries that is still relevant here. And then also, I think a lot of companies, and this is very common these days, right, that sell goods and services as part of bundled arrangements. Tariffs and kind of cost changes here could like necessitate the need to look at your standalone selling prices again and think about how that might change the allocation of revenue within a bundled contract based on kind of those changes to those standalone selling prices. And I think another thing here too, especially if you're going to negotiate any pricing changes that we talked about, right? Like being a strategy with suppliers is trying to maybe get some different pricing changes worked out. Depending on the situation and how those changes are structured, you could have things that are accounted for as additional variable consideration in the contract, or you could have contract modifications here. And so you need to apply that contract modification guidance in 606. So a number of things I think that fall under kind of the revenue space that companies need to be thinking about.
Okay. And just to be clear, tariffs are not treated like sales taxes under 606, right?
Right. Yeah, I think that's a good important distinction to raise here. So tariffs are not sales or use taxes, so they don't qualify. And we bring that up because there's a practical expedient to kind of exclude them from being presented in revenue. So tariffs do not qualify as that type of kind of tax to use that expedient. Here, instead, if the importer passes that cost to the customer, they're still going to recognize gross revenue and kind of gross like cost of sales. Mm-hmm. So obviously that can inflate your top line metrics and kind of distort your kind of gross margin metrics if you're not accounting for that correctly.
Okay. Yeah, that's actually a great point. So while we're on the topic of margins, let's talk about inventory.
Okay.
This is kind of a big one, especially for those middle market companies operating, in retail, manufacturing, and consumer products. How are tariffs affecting their inventory accounting under ASC 330?
Yeah, so great question. So under US GAAP, tariffs are considered part of the acquisition cost of inventory. So they should be included in your total cost of inventory. That means, if you're paying 25% tariff to bring a certain good or component of a good into the U.S., then that tariff is going to just be capitalized into that inventory. I think this, that accounting is pretty straightforward. That's nothing new. That's always been how tariffs are accounted for. I think here, just kind of given like the scope and scale of all the tariffs, I think what is probably a bigger concern is when your cost basis all of a sudden just starts to go up so significantly or, with less predictability, that it could essentially exceed the selling price or get kind of near that selling price. It can call into question whether or not there's an inventory impairment. So if the net realizable value of that inventory kind of falls below its cost, then under existing GAAP guidance for inventory, you'd have to write down that inventory value.
Okay, so you mentioned impairments. Let's kind of dive into that topic a little bit more. So whether it's inventory that you just talked about or intangibles or long-lived assets,
Hmm.
tariff impacts are going to start showing up on impairment testing, especially when it comes to expected cash flows. So how are tariffs specifically affecting how companies test for asset impairments under ASC 360 and ASC 350?
Yeah, and I think you kind of hit on it right there, right? Like we're definitely seeing this play out a bit more. You mentioned the cash flows. Obviously, tariffs can significantly impact maybe a company's kind of prior existing cash flow forecasts that they were using for a number of impairment analyses or just for, budgeting and forecasting in general. And that's from, squeezing margins and slowing down sales, all those different things. And that ultimately does flow into the way impairment testing works across the different standards. So whether it's the recoverability test that you first have to apply to long-lived assets, or like you said, you kind of have those fair value tests for indefinite-lived intangibles and goodwill, these cash flow forecasts can impact that. Um, I think one thing, and this is obviously going to be more true for, companies that are using an income approach, right, to kind of apply those impairment tests, and they're using kind of those discounted cash flow scenarios. Obviously, these kind of large swings in probably prior forecasts could have implications there that companies need to think through. And then I think the other point I'd raise here is we're seeing a lot of companies that are using cash flow models are kind of thinking about the different ways they're approaching that. So for companies that are using maybe just a single cash flow forecast, which I think some people do in more kind of stable environments. If you still plan to do that, I think obviously there's a need to think about the discount rates that you're using, just given the current volatility and the added risk you have associated with that. But I think also what we're seeing and talking to a lot of clients about as well is that a lot of companies that maybe even were using a single cash flow kind of model are now shifting towards multiple scenarios and applying different weights just based on different outcomes and probabilities. And that, helps in light of the current environment where we just have so much unpredictability with the current kind of trade policy going on around the world.
So let's touch on income taxes. What are the implications under ASC 740 when tariffs begin affecting performance?
Yeah, so there's, I think, a few things to think through here. So one is thinking about kind of just future taxable income. Most likely that's going to be expected to decrease because your tariffs are going to hurt your profitability. And the reason I raise that is because impacts on future taxable income can impact the realizability of any deferred tax assets that a company may have recorded on their balance sheet. So I would say companies that are potentially in this scenario just need to be thinking through the realizability of those deferred tax assets and also thinking about whether or not they need to book a valuation allowance, or if they have an existing valuation allowance against those deferred tax assets, there may be a need to increase it and refine that estimate of that deferred tax allowance. I think secondly here is, we've talked about supply chains and, companies potentially needing to kind of reconfigure or restructure those supply chains and how they manage their exposure to tariffs. This inevitably could have some inner kind of company pricing adjustments that are necessary. And when you have any of that kind of coming into the play, I would say this brings in kind of concerns around some of the transfer pricing risk and kind of the things associated with that, which includes like uncertain tax positions. And so just thinking about any documentation that may be necessary around some of that and any changes that it could ultimately kind of trickle down to the tax provision as a whole. Yeah, there's a few things here. I think from a U.S. GAAP perspective, there's kind of two standards that come to mind here. So you got ASC 275, which is kind of speaks to a lot of risks and uncertainties in the financial statements, which obviously in light of this environment, I think is very relevant. But if tariff impacts could materially change estimates in your financial statements, so you're talking about like cost of materials again or contract profitability, companies should think about additional disclosure there. I think a lot of times there's a lot of boilerplate disclosure around risks and uncertainties in most financial statements and kind of a stable environment. But I think for, especially the industries we talked about earlier, that could be more materially impacted, maybe thinking about expansion of those disclosures and providing more details there. And then also from a subsequent events perspective, I know, we're recording this kind of mid-April right here. Obviously, a lot of public companies have already filed their annual 10Ks already, but I think a lot of private companies are kind of working towards completion of kind of year-end audits and making their year-end financial statements available to be to the readers and stakeholders alike. And so they're probably still thinking through subsequent event stuff like right now. So tariffs that are enacted, I think companies need to be thinking about, or, ones that are announced kind of after the balance sheet date, but before those financial statements are readily available. They may not require any recognition in the balance sheet or on the income statement. But there could be some likelihood that there needs to be some disclosure around some of those subsequent events. So just something I think companies need to think through there. For public companies that are, now thinking through Q1 reporting and getting ready for that, I think there's potentially needs to update conversations around risk factors, just given the change in kind of trade policy out there, and then just in general around in their MD&A, right? I think there's going to be an expectation that companies, especially those with global supply chains and then in those kind of key industries, they're talking about, how these tariffs are affecting their operating results, their liquidity, and any critical accounting estimates that they may have. So a number of ways I think that, disclosures around kind of this topic and just in light of the environment, I think are necessary for companies at least to think through, and then to kind of decide kind of to what scale they need to add more color around this.
What about going concern? So is this coming up more often in tariff heavy industries?
I mean, it's hard to say is it or isn't. I think there's probably the need to do a little bit more rigor around it, especially for those middle market companies, like you said, that, we talked about that just don't have the larger kind of liquidity buffers, and maybe running already pretty lean with meeting some of their obligations. So if tariffs are materially affecting cash flows or creating uncertainty about future operations, those could be indicators that, management may need to think about whether substantial doubt exists. And then even if there is substantial doubt, right, then you kind of go on to the next phase of evaluating your ability to mitigate that substantial doubt and kind of overcome it. So if there's plans in place that companies are trying to do to mitigate it, whether it's raising capital or restructuring their operations, like we've talked about, which is a whole battle in and of itself. Those plans still also have to be, probable and also kind of executable to even be factored into that evaluation. So a lot of times, until those things are already done, you can't really take credit for them. So I think there's definitely going to at least be a need for companies and probably, from their auditors as well to, they're applying some pressure that companies need to be a little bit more rigorous in that evaluation of going concern, just in light of the environment. Yeah, so we're seeing tariffs add a lot of complexity, I think, across every part of that deal life cycle, which makes sense. So for buyers, right, you've got rising costs from tariffs that are potentially inflating working capital, your inventory, your payables, things like that. And so that obviously has downstream implications on purchase price, the closing statements, valuation models that are used. So that's one way. For sellers, I think there's pressure to explain margin compression, where they're either seeing it already or going to see it, and reduce performance. And that can even be before they're even negotiating any earnouts that they may have in the agreements. One thing both parties need to be thinking through here, and especially, when you've got certain provisions in purchase agreements, is trying to avoid that post-close dispute. So way things are defined or outlined and just maybe not contemplated in light of just where we are today in some of these purchase agreements, I think it could lead to just a lot of like arguing and disputes on how to apply some of those provisions.
Okay, so let's drill into working capital a little bit. Most deals use the phrase "in accordance with GAAP" consistently applied, but is that realistic when tariff costs kind of spike mid-process?
I think that's a big challenge that companies have to think about, right? So when costs jump due to tariffs, GAAP is probably quote unquote consistently applied, right? Because those cost of tariffs just get rolled into the cost of inventory.
Mm-hmm.
But what you really have here is the economic inputs have changed. And then so I think to help prevent misunderstandings around that kind of consistently applied, we're seeing, I think, a lot of deals using an accounting hierarchy. So more or less, they're kind of creating a set of rules or assumptions to govern how specific accounting areas are treated. And this is probably really common around inventory, just given like where tariffs generally tend to hit the most is around the cost of inventory.
Yep.
So if inventory costs are up 30% due to tariffs, both sides need to kind of agree up front how those are factored into working capital. And I think that just really helps avoid some, down-road conflict or disputes that could arise.
All right, so let's shift gears to earnouts. A lot of these are based on financial metrics like EBITDA or revenue,
Mm-hmm.
and that works well when things are stable. But when tariffs hit and suddenly costs go up and margins shrink, how should buyers and sellers kind of rethink these structures?
I think it's challenging, like everything we've talked about today. If a company raises prices to offset tariffs, that might hit a certain revenue target, but profitability could still suffer, right? So, you got to think through that, I think, a bit. I think what we're also seeing is a shift towards more EBITDA-based earnouts, which, candidly, I think a lot of earnouts are still tied to EBITDA even before kind of this environment. But I think what happens when you have EBITDA as a target, a lot of times there's provisions in there for certain add backs that are allowed. So, certain things that are quote unquote classified as recurring versus non-recurring and how those are treated are typically outlined in a lot of purchase agreements around earnout provisions. And so, there could be some debate, especially if it's not clear in existing agreements how tariffs are treated, like what are those qualify as recurring or non-recurring type of adjustments that allow for companies to potentially add those back. If you're in an existing agreement, that might just be something that's you kind of have to negotiate and figure out like what both parties are willing to come to and what clarity maybe exists or needs to be kind of solidified. And then for existing purchase agreements that are being kind of constructed now, I think it's really the guidance is, you need to be really specific in light of the tariffs and really how those should be treated and where all those impacts are and have clear definitions included in there. And that's just right to avoid, having vague language that is up for interpretation, leaves the question whether or not you're allowed to treat tariffs a certain way. So, an example here is I think there's a language around like extraordinary costs sometimes can be added back for EBITDA metrics. And so, historically, maybe there hasn't been a need to define extraordinary costs as detailed. But, in light of today's environment, it just may be necessary to add some more color there.
Okay, so let's kind of shift to the back end of the deal.
Okay.
Closing statements and reps and warranties. Do tariffs create additional risk here too?
They do. So we've already talked about how GAAP requires you to consider subsequent events. But in deals, I think it can vary, like how far any post-closing adjustments can ultimately go or how far that reach can be. So some things I think companies have to think through are, is there a material adverse change clause that tariffs might trigger? So those MAC clauses are often in agreements, and so you need to be thinking through, does that raise any of the implications under that material adverse change clause that you may have? The other thing to think about is supplier disruptions or price hikes. How are those affecting just the ordinary course of the business and the business language? If tariffs reduce kind of the net realizable value of inventory or impact major customer relationships that you have, Do those trigger any types of reps around inventory or contracts or reps around any undisclosed liabilities that you did not provide to the buyer? Those are just a few examples, but I think largely there's a number of ways that these tariffs obviously are just going to make deals and deal negotiations more complicated. And I think that's where deal teams and legal teams and risk teams are having to really spend more time up front trying to ensure that they're putting all the right protocols in place.
Well, that brings us to the end of today's episode. And if there's one big takeaway, it's this: tariffs are not just a trade policy issue, they're a financial reporting issue, a supply chain issue, and a strategic planning issue, kind of all rolled into one.
Yeah. And I think, we've said it in one way or another that the ripple effects are real that companies are feeling, right? You've got rising costs, shifting pricing models. We talked about impairment triggers from an accounting perspective. You got income tax consequences. All of that's on the table, and it's a lot for companies to really kind of get their hands around. And I think even with the current pace of just policy changes, companies really need to stay agile and get ahead of the reporting and accounting implications that may be present for them.
Yeah, exactly. So the key is to not wait for year end or your next audit to start thinking about these things. If you're reworking contracts or restructuring your supply chain, or maybe just simply trying to assess how these new tariffs will affect your reporting, you got to start now.
Yeah. And as always, we always like to put a plug in for ourselves. If you need help assessing kind of your exposure, understanding the financial reporting implications, like you mentioned, or just even building out what are some actionable next steps you should be thinking about? We're obviously here. Embark is here to help you. We know this is complex stuff. We know this is rapidly changing stuff here. There's a lot to really kind of stay up to speed on. And so, we can help you break that down and work across accounting, tax, and operations to really help support companies that are in need.
Yep, of course. You can always connect with Adam or me on LinkedIn. We'd love to hear your questions or talk more about what you're seeing in your business. For more insights and other resources, head to embarkwithus.com. Thanks again for joining us on another episode of Accounting Matters. Until next time, stay curious, stay proactive, and we'll see you soon.